After the discussion about cryptocurrency and Bitcoin, I think I have something which is more fundamental, which is something we use at Cube. We call the 9-box method of how to think about your money and how to invest. So let's jump into it. Just Rishabh, go to the next slide. So it's interesting that people think about investing as if it's a static activity. It's not, absolutely not. It depends a lot on your life stages and how they're changing. From your first job to as you mature and as you maybe enter into a family situation to when you have dependents, either children or parents, how your earning years change from where you have struggling to save some money to having excess money where you don't know how to allocate it. And then as you head towards retirement and you have to start thinking in a different way about money. So these are the life-changing stages which are very important in your investment journey. Most people don't think about it that way. They think about, okay, I need to start investing, period, right? So we're going to talk about how the 9-box model is a part of this. Next, Rishabh. No, the one before this. And the other very interesting and important part of this is we all individually have a different psyche about money. It depends on everything from how we were raised, what was our family situation, whether we grew up with excess, whether we grew up in scarcity. It depends on whether we overheard our parents investing and losing money versus our parents being successful and patient in investing. There's actually a great book that I would recommend that's an easy read for everybody. It's by Morgan Housel, and it's called The Psychology of Money. So it's worth reading this to realize that your specific philosophy and approach towards money is not wrong. If your friends are trying to debate with you and convince you that their method is better, all you should do is listen, understand, but not ignore the fact that you have a particular mindset about money for a reason. For all the years you've lived till now, you might have forgotten the incidents that caused it, but they are very important. And the reason I emphasize this so much is money is not the end goal. Money is the byproduct of living a good life. So if investing creates stress for you, you need to address it by changing your investment strategy. And if investment is like a big game for you, you need to understand that you're treating it like a game and understand that like any other game, there could be wins and losses. So when you combine these two, Rishabh, we go next, what you have is your risk level, which is a combination of your life stage and your psychology with money. And this is something that we find again and again in Cube that most people don't understand. People look at, if you ask people to estimate and say, what is your risk level? More often than not, they get it completely wrong because they don't understand that these two factors, each one by themselves is very complex, is an important factor in money. Next. So the 9 boxes, when you break it down this way, are risk level on the X median, low, medium, high. And then for your life stage, there's a time dimension, short, medium, long, and it stretches along. This basically forms the 9 boxes, and you have to color out in a very basic sense which boxes matter to you, because you really don't need to fill each and every one of those boxes. Next, Rishabh. So actually, it's just 7 boxes because the two extremes of this matrix don't really matter. If you're investing for the short term, you should not be taking high risk. This is just, it's contradictory, right? Why would you invest in something for the short term? Because you want the money short term, right? You need it and we define short term in Cube as 0 to 3 years. Medium term is 3 to, let's say, 6 years. And long term is 6+ years, approximately. If you need any money in less than 3 years, you should not be risking it on a high stake stock market gamble or a cryptocurrency gamble. Flipping it inversely, anything that you need to invest for the long term should not be in low risk. Why? This sounds contradictory, especially in India. The reason why people don't understand this is there's something called inflation. And in India, forget the government published numbers around inflation. They are bogus. If most of Cube's clients live in urban cities, and all of you, if you reflect back to the last 10, 20 years, you've seen how the cost of living has gone up. The cost of living has gone up, but also your aspirations have gone up. So any money that you're aiming for the long term cannot be put in a low risk investment, because you actually tend to either actually become poorer because of inflation, or you feel you have become poorer because your aspirations have gone up. So you'll knock off those two buckets, and we'll ignore those in the next couple of scenarios. Next, Rishabh. So let's take some examples, right, of some prototype customers. So we have Nena. She's in her 30s. She changes jobs every couple of years. She likes the excitement of new work. She has a pretty high level of income. She has no dependents, and she has some very basic savings. So think about what fills the boxes for her. In the short term, she needs a safety buffer because she changes jobs often. She doesn't have significant savings, right? So she wants a combination of low risk short-term money kept aside. She also needs, because she has no dependence, she can also put a little bit more risk in her medium to short-term money and put that box as well. But because she has no dependence and a good income, once she covers these two boxes, she really should be betting on high risk, medium and long-term investments, because her income's not steady. Her savings are not very high. In the longer term, the only way she gets out of this cycle of being financially dependent on her income is if she starts investing in high quality assets, high quality advisors for the long term. This is what creates wealth for somebody like a Nena. If you look at the next example, this person is not that different from Nena. When you think about just the highlight, right? They probably hang out in the same social circles. She's in her 40s, again, like Nena, stable income, one dependent, good savings. But why is her profile so different? For a very simple reason, that because her income is more stable, she doesn't need to risk staying in the low and short category. Let's say her job is a very steady job in a large organization. She can afford, even in the short term, to keep her money in medium risk instruments. Why medium risk? Because they typically give you 50 to 100% more than a low risk instrument in the short term. Similarly, because she's a little bit later in her life cycle in age, her medium term investments can also be medium risk, because she can't be very aggressive because she has a shorter time frame towards retirement. But it's not that short that the long term cannot be high risk. So that's why you see the three squares that are colored differently, just with small changes in profile between the two. But let's take a look at a more extreme example on the next slide. So for Vijay, he's in his 60s. He has got no income. He's retired. He's got one dependent, his spouse. He's got good savings. Now, suddenly the situation is very different. The squares that you see. Why? He depends on his savings for all of his short-term needs. So anything short-term cannot be at risk, because that literally pays the bills per month. So that's a very clean square in the low short-term area, nothing in the medium short-term. But medium term, again, he needs a little bit more conservative an effort. You could debate and say it could be low or medium risk in the medium term. Given that he has good savings, he has some ability to deal with fluctuations. So in this case, we've gone with medium risk, hoping for the higher return in the 3 to 6 year period. Long term, again, he needs to take a risk. This is again where we see a lot of people near retirement making a mistake of saying, I need to be very conservative or moderately conservative. The reason it doesn't work is, with today's science and medicine, progress in medicine, it's very likely you live 20, 30 years. That's not a small period of time. So again, inflation kicks in, lifestyle changes kick in. So it's very important for Vijay to balance having medium risk long-term and high risk long-term in his portfolio. So he has some stability, but he also has a chance to create significant wealth. So in these three examples, what you're seeing is very small changes are subtly indicating how your investment strategy should be different based on the 9-box philosophy. If you go to the next slide, some finer points, right? The nine-box philosophy is great to start. And I really hope each one of you takes an opportunity after this to do analysis for your own life stage and psychology. One of the key finer points is you fill these buckets top down. So if you look at that square grid, you need to first fill up the short term, then you fill up the medium, then the long. Many times people make the mistake by just jumping to say, oh, I must start investing. Let me buy stocks or mutual funds. No. The short-term emergency money, the short-term money you need in the next 3 years is what you first need to save for in the right instruments. Within each box, you also don't put all your money into one instrument. You diversify into at least 2 types. And within Cube, you see that we force you in most of our recommendations to put it into at least 2 mutual funds in any category. Even if you're doing alternative investments with us, we'll say very clearly, don't put all your money in one asset, however confident we are about that, because it should be diversified. This is just simple hygiene. What do? You don't touch this money very often. If you touch it very often, it creates tax impact. It creates stress on you. But what you need to do is monitor it once a quarter to see if it's on track. And this monitoring really takes just a few minutes. And I'll point you to a link to how you can monitor it on your own. And then you need to evaluate it once a year or change in life events. Once a year is important as a hygiene. And literally, if it takes you 2 hours once a year to look at what your future financial freedom could be like, it's completely worth the time. Or if there's a change in life events, such as if you give birth to a child, or if you change a job from, let's say, a large company to a startup, where your income is not necessarily that stable, or you've taken a hit in income to go for equity, all of these life changes require you to reevaluate what's the right 9-box portfolio for you. Another classic example in India is when people buy a home. When you have your first home, you have a pretty big EMI component. That's when your flexibility with what you do with your money goes down dramatically. And that's when you want to take the analysis again to check if you're on track. Rishabh, next. So common mistakes are starting too aggressively. We see that very often in people in their 20s, 30s. They talk to their friends. There's a lot of josh. They think investing means investing straight in the markets. Let's buy a mutual fund that did really well last year. Let's go to this app that's popular and see their blog posts and start investing. That's a terrible idea. The flip side of that is staying too conservative, which is what the vast majority of India does, which is keeps all their money in fixed deposits, gold, real estate. Again, both of these strategies are too extreme. What you need is a more balanced strategy. And that's what we spoke about. Filling 7 of those boxes, at least 3 or 4 of the 7 boxes need to be filled to have a diverse portfolio, which is point number 3. The 4th point is forgetting to adjust plans. You must adjust your plan as your life changes. And the last one, which is very important, is not demanding quality. Everything you've done till now is wasted if you actually don't buy a quality mutual fund, or if you don't find the right alternative investment or the right crypto coin to buy, and you get excited by somebody who tells you, oh my God, this crypto coin is hot. It went from 0.1 cent to $2. It makes no difference. Human beings are irrational. Markets drive prices up, markets drive prices down without understanding what's fundamental value. So you want great quality advice to guide you to say what's real, what's fake. You can play with fake money, but think you're going to a casino and allocate 2%, 5%, or a fixed rupee amount and go play with it, right? But it's not investing. Dogecoin. There are so many people who ask us about dog or Dogecoin. I don't even know how to pronounce it. And it's a meme coin. It's a joke. It has no utility. It has no value. People just play around with it. It's not an investment. What Nishal said was very interesting. People get scared and they're like, oh my God, Bitcoin is $58,000. I can't buy that. There's a cheaper coin. That doesn't matter how cheap the coin is. It's about the fundamental value, the market cap of that particular store of value or that company that matters. So Google being cheaper than Apple has no relevance at a per stock value. And this is what a smart advisor helps you with. Next. So to close, how do you know what are your boxes? Well, in the Cube app, if you open it up and go to the Discover tab and go on the top corner to the Perfect Portfolio Builder, we start guiding you on how to analyze your life, your current portfolio, your current risk mindset, to guide you towards how to think about the right portfolio. Following this, given that almost all of you are prime customers who are on this webinar, you can reach out to your Cube Wealth Coach to fine-tune your plan further. And once you combine these two elements and you monitor them once a quarter, I can guarantee you'll have peace of mind and you'll have a portfolio that's actually humming along really well. So that's the 9-box model. Happy to take questions now, but again, each of the wealth coaches are also trained to explain and sit down with you, understand your existing portfolio, tell you what to enhance in that, what to get rid of from that, which is on the wrong track based on your life stage. Rishabh, that's it. I'm happy to take any questions.
Yes, I'm just going to open up the chat and see if we have any new questions. I only have compliments. I have a message saying good information, very useful for a beginner. I have one saying this is an interesting way to look at it. So guys, if you have any specific questions, you can keep pinging me like you were pinging me earlier in the chat itself. I have a thumbs up now. Okay. So apart from liking this, if you guys want to ask me any questions, please ping me here.
Absolutely. So and again, this is a serious topic. Feel free to write to your wealth coach about this. Rishabh will send extracts from this seminar and the presentation out to all of you. I really encourage you guys to read that book, The Psychology of Money. It really helped me understand how I'm afraid of money and afraid of spending too much, as an example, in my lifestyle, because it's all of our backgrounds. And it liberates you when you realize you're not wrong. It's not that everybody else is right or has it figured out. We have a right to think about money as a very personal tool. And we are happy to talk to you about where you're coming from regarding money and how to build a portfolio so you can sleep well at night. Maybe you make a few percentage less returns in the long term, but if it helps you sleep well because you're not stressed about it, I think everybody at Cube will be very, very happy about it.
Okay, Satyan, one question I have for you is, how does insurance fit into this methodology of 9-box?
Absolutely. So when I said the bucket philosophy in Cube that you'll see when you go to that wizard we have, we say first you need to save for emergencies. And the amount you save for emergencies depends on your monthly expense and the number of dependents you have. The wizard guides you. After that, you must buy insurance. But also insurance don't get scammed. Buy health insurance, buy term life insurance. And if you travel abroad, definitely buy travel insurance. And then obviously for a car, house, etc. And after that, you really start investing. Emergency and insurance are not investments per se in the traditional mindset, but they're investments in protecting your money and your lifestyle. So after that is when you go into the short-term, medium-term, long-term buckets. And again, this is explained in the wizard. For this presentation, I kept it simple. That's a great question. And by the way, at Cube, you can have a couple of options of what insurances you want to buy. Again, similar to the investment options, we've done a lot of due diligence about the best, most reliable providers. And your wealth coach can help you get access to that at some of the best prices we could negotiate for you.
One question I have is, should I classify Cube as an investment platform or an advisor?
Cube is a platform. So what we do is we curate and find the best advisors and the best assets for you, but we are not an advisor per se. What we do is we build these guidance algorithms that educate, hopefully, our users into how to think about investing. For which particular stock to buy, which particular mutual fund to buy, is not something we are qualified to do. And that's why we find the best advisors who know how to do that.
One question is, there are a lot of young investors who are looking for short-term, high-return risk box to create corpus quickly. how do you dissuade them from getting into this? For example, a lot of people end up doing intraday trading as when they're starting off investing. So how do you dissuade them?
Well, first of all, we start by not calling it investing. It is called trading or gambling, right? It is, I mean, if it was that easy to make money, everybody in the world would be rich. Remember, when you're doing short-term trading, when you make money, somebody else on the other side of the trade is losing money. There's no free money out there in the market. If you think you're one of the smartest people in the world, so you can keep winning, go for it. Power for you. There are people who are that smart. The average person, by definition of average, is not better or worse than the everybody else, right? They're at the average mark. You will win some days, you'll lose some days, you'll get stressed, etc. If this is not what you love doing, make it passive. Do it the right way. Let it be. Observe it once a quarter, and you'll be good, and you'll be happier for it. So you can enjoy the rest of your life. There's no easy money in the world. It doesn't matter. You hear about a few people who got lucky quickly, but you don't hear about the thousands more who lost a lot of money.
So the next question is that in India, there's a huge amount of money that's invested in real estate, not just for living, but for rental income, or purely for appreciation as an investment. So where does this fit in, and do you recommend doing this?
Yeah. So real estate has been very popular in India for many, many decades. When India was a muted economy, real estate was the only one that kept going up because our population kept going up. Obviously, now we are an open economy. There's a lot of boom in multiple sectors where the government is involved, the private sector is involved. If you see in the most urban areas as an average, the last 10 plus years, real estate has not produced returns, right? First is that. Second is just think about what you're doing when you buy one or two or three properties. One, you're taking a very concentrated bet that that particular project will take off, that locality will take off. Second, you're taking ongoing maintenance work of renting it out, paying stamp duty, doing maintenance work. If you ever need money in any sort of situation, you have to find a buyer, you have to negotiate prices, again, pay duties, and then wait for the money to come back to you a few months later. Think of the alternative that the new India is offering, let's say just a stock or mutual fund market. You find with a good advisor the best stocks or the best mutual funds to buy. What are you doing? You're having the best CEOs of India building companies day to day for you to produce returns for you. And what do? To get into these companies, you have to press a button, send money. If you ever need money, you press a button, in 2 days, you get your money back, right? You get everybody from the CEO of HDFC Bank to Asian Paints to Tata, right? Working for you effectively when you become a stock owner. How amazing is that without any of the downsides? The only problem is when you want to get rich quickly, like the previous person asked, that's when you start losing money in the stock market. That's why we like our advisors who have long track records of being patient in the market. We don't like it when they tell people to sell because that means their tax liabilities. But at least we trust them to know what they are doing.
Okay, I'm going to club the next two questions because you can answer them together in a way. So if you're getting the best advisors via Cube, can we look at direct investment model for MF in the coming days? And the second part of it is, what other new assets can we expect on the Cube app?
Absolutely great questions. So for direct investing, one problem, I'm very transparent with everybody, is our advisors don't work for free, right? They are very pedigreed. They need to be paid. So Cube pays them for their services. This is not well known. And the way Cube can pay them is because we make a small commission off the investments all of you make in mutual funds. And this is the only way we can have a robust business model to produce and keep giving these kind of quality services, but also how that advisor stays engaged with us to keep providing that quality of advice. If we move to a direct model, we'd have to make it a subscription service like how we have for stock advisory. And we've thought about that in the past. But what we found is, in general, people are so used to buying mutual funds directly without paying a cost on top that becomes a big change. But again, if you are interested in this, please write to us on our WhatsApp channel. I would love to make it a subscription fee only model. It actually reduces a big conflict of interest issue for us. What kind of assets should you expect? Well, one is the poll we just ran on crypto. If there is a good, strong response, we know that the government is still kept it in a gray zone, but we'd love to introduce it because it's a global asset. The other things we look at very, very actively are new models of investment, such as lease financing, fractional real estate ownership via effectively units. So you avoid all the problems of real estate of having a concentrated bet, not having liquidity, etc. We are looking at both of these as options coming up. We are also very actively working on adding more stock market advisors on the Cube platform. So you have options beyond Purnartha as well.
Awesome. I couldn't see what somebody uploaded at that last bit. So I think there's some positive interest there. Okay, Satyan, would you like to say anything in closing? I just want to then talk about the portfolio analysis that's going to go to everybody via email.
Well, I'll say one closing thing. For everybody at Cube, this is a work of passion. Everybody from Barun to Zeba to everybody, all of you interact with. Please use our services to build and think about your portfolio just for a couple of hours once. And so we can put you on the right track. Use our tools as well to get on the right track. Because trust me, once it's on the right track, it'll take you guys a few years, but after a few years, you'll thank us. Because it's amazing how confusing the world of investing has been made by everybody out there who wants to focus on selling you things that you don't understand. The reason why everybody tells you to buy mutual funds is that's where they start making commissions. They don't tell you to buy liquid funds, debt funds, etc., because the commissions are very low in that. We are the opposite. We want you to build the short term first, the emergency first, then go medium term, and then go long term. Long term is where we also earn the most money, but we want you to follow that process so that you have a very healthy portfolio that stays balanced and makes you go towards that path of financial freedom. Please use our services liberally. I mean, we are starting this Prime trial to start the membership model, but that's because we also have to have a sustainable business model, but we are more than happy to make exceptions. Right now in the trial, we are anyway giving free portfolio creation and analysis. I highly encourage everybody to use that.
Awesome. Thank you. Thank you so much, Satyan. So guys, before I close the session, I wanted to remind you guys that this webinar includes a free financial analysis, an in-depth analysis of your mutual fund and stock portfolios. Details on how to get both of these will be emailed to you after the webinar. So make sure you look for an email from Cube Wealth. Make sure you check your spam inbox wherever, because you don't know where the email will land. And once you do this, you'll be able to see a breakup of the good, bad, and all the funds and stocks in your portfolio. Will start making sense. You'll be able to course correct if required. And feel free to reach out to your wealth coaches if you have any other questions, or if you don't find this email, we'll still be happy to send it across to you if you haven't found it. And again, and in closing, I'd say thank you so much for joining us on a weekend and taking this time out to think of your investments. And we look forward to helping you cube your wealth.